GreenDragon Gas is a coal bed methane producer operating in China and listed on the stock market in London on the main market. In the past 18 years, operating in China in partnership with Chinese companies Sinopec and PetroChina, GreenDragon Gas has secured and de-risked a large asset base of around 549 BCF of net proven and probable gas reserves, with an upside of up to 2.4 TCF. The company produces currently about 3.4 BCF per annum from 2 licenses located close to the country's main gas transportation infrastructure, enabling access to the main demand center on the eastern coast of China. GreenDragon Gas benefits from a supportive policy and subsidized gas prices by the Chinese government in order to encourage the utilization of indigenous gas resources as a source of energy. The aim of this policy is to fight pollution in first instance, because gas is obviously less carbon intensive than other energy sources that China uses at the moment, and as well as promote energy independence. We believe the current share price reflects investor concern on the financial situation of the company, as well as the mixed operating performance in the past, and as a result, the share price have performed poorly. It is true that it took the company a long time to reach current production levels, and it spent more capex than originally anticipated to reach current levels. The company had to adapt coal-bed methane production technology to the specificity of the Chinese coal geology, which has lower porosity and higher water content than experienced in the rest of the world. Also, the company had to defend legal challenges by its local partners. All that took time. Now, obviously, this is all in the past, and this is reflected in the current share price. As we see it, the more pressing issue is that the company faces very high financing cost, as well as an $88 million debt repayment, which is due in November this year. This is precisely why we believe now is a good time to pick up the shares. The company recently started to roll out a new wellhead compressor technology after tests showed that it has the potential to double the flow rates of existing wells. We believe that a steady rollout of that technology should translate into double-digit production growth in 2017. This expansion requires low capex and should result in healthy free cash flows, which in turn should provide the necessary confidence required to address the financing challenges, either by raising additional finances from the debt market or agreeing to some industry farm-outs. The company recently managed to secure an extension on an existing bond repayment of $50 million, which was due in June 2017, which I think vindicates that approach. Increasing existing production rates of existing wells is one source of growth. Another source of low capex growth is the large pool of already drilled wells, which are waiting to be connected to the sales infrastructure. In terms of timing, we know that it's unlikely that the company would solve its financing issue before mid-year due to the time it would take to complete either process, either raising debt finance or industry farm-outs. However, we believe that the market could react quite positively to any positive news flow regarding production and in anticipation to new finances materializing. We believe that such positive share price reaction could be material given the low stock liquidity, and under this scenario we value the stock at 247p, which represents a large upside to current share price level.